Should you go variable or should you go fixed? It's like asking yourself if you want to put on a t-shirt today or put on a jacket without looking at the weather outside. It's not that simple, but context matters and everyone's own personal situation is unique. There's no one-size-fits-all. I'm going to list a few considerations in order of importance from our point of view here at Pinsky Mortgages. Are you a first-time home buyer? How long are you going to live in the property? How risk-averse are you? What's your budget and payment expectations? What are the current fixed and variable rates? What are your expected changes of the variable rate in the next few years? And do you have any outside pressures to pick one over the other? Before we go into a couple of the considerations in detail, I want to explain on a very high level what the difference between a fixed rate, a variable rate, and the third option, a fixed payment variable rate is. A fixed rate is just that. Your rate is fixed for the term or number of years you've chosen for your mortgage. In most cases, the best bang for your buck is the 5-year fixed rate. This means that your interest rate and your payments stay the same for 5 years. At the end of the 5-year term, you can take your mortgage to another lender, or you can sign a new mortgage contract with the same lender. Quick note, your term is not the same as amortization. Your amortization is the length of time it takes you to pay off your mortgage. Your term is the number of years you've locked in your mortgage with your current lender. Variable rates, on the other hand, generally have lower rates at the outset, but they're dependent on the Bank of Canada monetary policy. If the Bank of Canada increases rates, your variable rate mortgage will increase and your payments will also increase. Most variable rates are also on a 5-year term. This means that you may move your mortgage after the 5-year term is completed. There's one other mortgage out there. It's called the fixed payment variable rate mortgage. In some cases, this is an excellent product because yes, your interest rate will fluctuate with the Bank of Canada, but your payment stays the same. The mortgage achieves this by either increasing or decreasing the amount of outstanding mortgage each payment pays off, in step with the interest rates either increasing or decreasing. With fixed rates and normal variable rate mortgages, your principal payment is set because we set our amortization or length of time it takes to pay off the mortgage at the beginning. Because of this, we'll know exactly how much of a mortgage will be left when the term is up. However, if the rates change and we have a fixed payment variable rate mortgage, our amortization actually changes because we don't end up paying the same amount each month to the mortgage. It's a little confusing, but it's not that bad. Don't hesitate to ask us if you have any questions about this type of mortgage product. Okay, let's look at a few considerations. First off, are you a first-time home buyer? If yes, you really might want to look at the variable rate mortgage instead of a fixed rate. The reason for this is that more often than not, actually 68% of the time, first-time home buyers change their mortgage within the 38th month. So why does this matter? Well, if you change your mortgage and you're locked into a term, your lender is going to penalize you for trying to get out of that term. And what lenders don't tell you is that fixed rates can have penalties about 10 times higher than variable rate mortgages. All in all, the rule of thumb is that fixed rates have penalties anywhere from 2 to 5% of the outstanding balance, whereas a variable rate mortgage can have penalties of about 0.5%. In other words, if you have a $500,000 mortgage and you broke your mortgage term because you had to sell or refinance, you're looking at a penalty of $10,000 to $25,000 with a fixed rate, but only around $2,500 with the variable rate. Quick note, if you do sell and buy, you can port your mortgage from one home to another. But if the dates don't line up perfectly, you might not be able to take advantage of this option. So if you are a first-time home buyer and you're not sure how long you're going to keep your property, getting a mortgage with a large penalty can be the wrong choice. Experience really has shown us that penalties can come up, and they come up more often than not. In 2020, I even paid $35,000 in penalties when I refinanced my mortgage. Well, how about if you're extremely risk adverse, or if you think interest rates are about to rise significantly? This could be a great reason to choose a fixed rate mortgage. Alternatively, some people like the stability of a fixed payment while having a low payment, but the flexibility of the variable rate penalty. In this case, you might want to take a fixed payment variable rate mortgage. All in all, your choice will depend on quite a few factors, and it's our job here at Pinsky Mortgages to educate you about each mortgage option, the flexibility, and the fine print. Thank you so much for watching. I'm Eitan Pinsky at Pinsky Mortgages, a Vancouver, British Columbia-based mortgage team. If you enjoyed this video, please share it with somebody who you think could benefit from the information. And as always, if you have any home financing questions, please don't hesitate to contact me or any one of our amazing team members.